Good afternoon and welcome back to another session of Market Mondays. And this is Singhyo covering for Tillen, who's on leave for 2 days. The STI has gained 6.5% month to date after crossing the psychological 4,000 threshold on 2nd of July. Several drivers and positive externalities are supporting this trend, which include 1. US markets reaching new highs, 2. Positive tariff news flow, and 3. MAS appointing the first batch of fund managers under the 5 billion Equity Market Development Programme, or EQDP in short. Now, momentum is likely to stay strong as this is going to be a busy week, probably the busiest of the year, with over 30% of S&P 500 companies reporting, including Apple, Amazon, Microsoft, and Meta. Now, with the conclusion of tariff negotiations between US and EU just over the weekend, and President Trump announcing 15% tariffs on the EU, focus will now shift to China. U.S. Treasury Secretary is currently scheduled to meet with his Chinese counterparts in Stockholm on Monday and Tuesday to discuss extending the August 12th deadline for higher tariffs on Chinese goods. FOMC will also be announcing its interest rate decision on Wednesday, and Friday will close the week with the non-farm payrolls report. Now, over in Singapore, banks will be reporting 2Q25 soon, with OCBC scheduled on 1st of August and DBS UOB on 7th of August. So today we'll be giving a preview on the bank sector. We also have an update on the topic of sustainable investing and whether there's still positive correlation between meeting ESG expectations and achieving superior performance. But first, let's speak with Jarek on the impact of Singapore government's EQDP program and what this means for the STI. Jarek, welcome to the show. With the MAS appointment of JPAM, Fullerton, and Avanda to manage the first 1 billion tranche of the EQDP $5 billion program, what's to be read from this development? Can you walk us through, please?
Sure. I think so. I think that I mean it's a positive step. Basically, it's something credible that it shows that the government is actually really going to put effort into boosting the small mid-cap valuations in Singapore. So from what we heard, basically, I think non-STI stocks, no banks, and also no REITs can be included into this investment. Only certain STI stocks, but it depends on the fund strategy, and also not just that 1 billion will be deployed. I think all these players have to raise outside capital, and we don't know what's the ratio, maybe 1:1, 1:2, but it depends on also their strategy. So it actually means that, there's actually a lot more equity capital coming in, and it's only for a selected amount of stocks that are available, and not for your STI related stocks, except for some, and also no banks and also no REITs.
Okay, so sounds like a very concentrated flow into the non-index sector. What are your top 5 picks then?
Sure. Okay, so for us, we like Food Empire, CSE Global, ComfortDelGro, as well as ISOTeam, Frencken. Yes, correct. Yeah. So I'll walk through one by one in a quick one. So we'll start with let's say Food Empire first. So basically, why we like Food Empire is that because they have been actually performing well. This year they will be doing better because coffee prices, raw material prices actually went down, and ruble actually strengthened. And if you look at last year, they actually did quite a few rounds of price increase because to counter all this negative raw material prices increase. But now after raising prices, basically raw material prices drop. So we do expect margin improvement in the subsequent quarters for Food Empire. At the upcoming results, we expect the first half numbers to be very strong in terms of their core profit. Yeah. And next.
Before we move on, Jarek, with Food Empire's core market very much concentrated in Russia, are you not at all worried about the the way that the tariff negotiations are going with Russia at this moment? I mean, there's always a high chance that US could slap on more punitive measures on the country, given what's happening with the Ukraine situation.
I think because for Food Empire, they are doing in consumer staples. So normally for UN and for human rights, normally even in war, for example, like when the war first happened, normally such items are not being tariffed or sanctioned because I think it's basic human rights for example, coffee powder, sugar and stuff like that. So like even for rice, I think all these items will not be sanctioned or tariffed by the US even if the war continues to worsen or maintain. So I think for this part, I'm not very worried. And also, if you look at Food Empire, they've been diversifying their revenues away from Russia. I think in the first quarter, Southeast Asia actually became the largest revenue contributor, larger than Russia. And going forward with their plans to build, factory plants, coffee plants in Vietnam, in India, and Kazakhstan, going forward, revenues from Russia will likely be a smaller percentage of the group. So all in all, with all these factors, we do think that, Food Empire should be still faring better, despite Russia being a smaller contributor of the group.
That's interesting. Thank you.
Sure. All right, next, I'll move on to ISOTeam. So basically, ISOTeam is a company that we like. We do think that, in the recent budget, they also announced a lot more BTOs, a lot more upgradings of HDBs, and also a lot of repainting now that the government wants the paint to be a fire sort of a cooling paint where it will help to bring down the urban area temperature, and all these building HDBs have to be repainted with the urban cooling painting. So we do think that there's a lot of opportunities for ISOTeam. They just announced a contract win of 20 over million last month, and earlier this month, and we do think that there should be more upcoming next month and in the near future because of all these upcoming projects. And we do think that ISOTeam is also one of the main beneficiaries of the construction boom upcoming the next few years. And upcoming numbers should be actually very strong in terms of core profit as well. We do expect their profitability to jump from 1+ million last year to probably about 6 to 7 million this year. So net on net, we do think that ISOTeam, with the good trading liquidity despite the market cap being small, could be one of the potential beneficiaries of this 5 billion program as well. And next, we move on to ComfortDelGro. I mean, if you look at Comfort, I mean, basically, they are one of the rare, I would say, mid-cap stocks available with, blue footprint. If you look at, they are having a 5.5% yield. They are trading at about 15 times PE. They are still growing year on year with the acquisition of Edison Lee back in the fourth quarter last year, and the earnings start to kick in the first quarter this year and more in the second quarter this upcoming results as well. And upcoming, they have an interim dividend of about 3.5 to 4 cents to mitigate our downside. So all in all, if you look at what's left in the stock market for mid caps, there's not many quality names left to buy. So with the 1.1 billion sort of set to be deployed, somewhere, rumors to be in August or September. If you're a fund manager with like 100, 200 million, what can you buy? I think Comfort is one of the rare stocks left that you can actually buy for good yield. And with Treasury, Singapore Treasury rates dropping in the last few months to 1+%, Comfort offering a 5.5% yield is actually quite attractive. We do think that yields should normalize for Comfort to about 4%. That means the share price could actually go up to maybe 180 to $2. We do think that is very possible in the next 6 months to 12 months. So, that's for Comfort. Next, I'll move on to CSE Global. I mean, CSE Global has always been one of my top picks since last year. Basically, I think they are the key proxy for what's happening in America. Trump wants to bring back factories, wants to build data centers, wants to increase oil production in the US, and this is all three suits into what CSE is doing. Automation and is their bread and butter in oil and gas, and then they pivoted into data centers, of which they are already working very closely with one of the largest data center players in the US. They're in the midst of qualifying for another 2 more, which we think that they could secure potentially 1 by the year, and that makes them to have 2 out of probably 4 big players in the US. And we do think that this advancement in the data center front should be quite interesting in potentially the next 6 to 12 months. And we do expect more revenue from electrification in the US in also the next 6 to 12 months, especially big project wins. And also with the election over, we also expect the Singapore government to spend more to upgrade their systems, and CSE will also potentially be a main beneficiary of that. And we do expect large contracts to come in 3rd Q or 4th Q this year for CSE. So that's something to look out for. We think that there's quite a big potential re-rating for CSE to come, especially if they advance much further in the data center space in the US.
Right.
And lastly, I'll move on to Frencken. So Frencken is our top pick for tech, for semicon manufacturing in Singapore. I think they are trading at a discount towards peers of AEM and UMS. For Frencken, I think currently the PE is about 18, 19 times, whereas UMS and AEM is at 23 times and above. So we do think the pricing gap is something that's attractive. Next, Frencken has also announced plans to expand its Singapore factory in Singapore, and that is only possible if they have commitment from its key customers. So we do think that their key customer like ASML, AMAT is giving them quite big, good outlook or firm commitment that they are willing to spend around $40 over million, sorry, $60 over million to build a new plant in Singapore with larger clean rooms. And also, if you look ASML recently, they came out with a profit guidance that they are not very certain of 2026. But with now Trump administration looking to sort of relax the semicon export rules to China, that could be actually quite a good kicker to Franklin's clients like ASML and AMAT, and that would indirectly also benefit Franklin. So we do think that Franklin is also another key beneficiary in a very sweet spot for this 5 billion program as well. So these are our top 5 topics for the 5 billion program.
Okay, thanks, Jarek, on that. Jarek, before I end the session with you on this last point of the semiconductor sector. Well, obviously there a lot of a lot of investors are also waiting for the outcome of Malaysia's negotiation with the US in terms of the semiconductor space, and likely something may be announced before the August 1st deadline comes due. Any expectations on that front also?
No, I think somewhere between, if the tariff is between 20 to 30%, would be positive, would be a positive sign, because I think if you look at Vietnam is around 20%. Now China is also talking about 20 to 30%, and then Europe is now at 15%. So for Malaysia, I think if they can be equal to that of Vietnam, that would be actually a positive already. I don't think it's possible for them to come down below 20%, given that Singapore is around at least, maybe the expectations at 15% for Singapore. So I think Malaysia should actually be at a higher tariff than Singapore, especially. So somewhere around 20% would make them very competitive in Southeast Asia.
Okay, great. Jarek, thank you. It's always a pleasure to speak with you.
Thank you, Zing. You're on
Now
the show.
let's talk to Xuan Hao on the banking sector at the moment. Now, with interest rates on the decline, it's inevitable that we will continue to see margin, or more specifically, NIMS compression going forward for the sector. Now, Xuan Hao, does this concern you, and what positive drivers will you be expecting in the upcoming results season for the banks?
Hi, thanks, Daniel. So I think on the topic of NIM compression, this issue has been much anticipated within the sector. So definitely no surprises there. However, one of the other main concern that we would have would be on the asset side. So we have seen asset yields coming off quite significantly, with T-bills falling like 127 bips year to date, with the 3 banks parking liquidity in high quality and low yield assets. So this may present a significant squeeze on NIMS. But in terms of positive drivers, however, all attention would be definitely on the anticipating higher non-interest income upside. So we have seen FX, commodity, and interest rates volatility boosting trading income. And in terms of wealth management, we should see some sequential improvements. So falling benchmark rates and risk-on status in the market should push loan-related fees up as well. So we definitely remain conscious on the NIMS, but we should see some upside on the NOIIs. And so, but we have to take note that non-interest income might not arrest the weakness in this NIMS compression.
Okay, all right. So let's talk about what might. On capital returns and special dividends, do you anticipate any surprises here?
Definitely we hope there would be, but as management has reiterated in Q1, I don't think there will be surprise dividends at this point in time. So we are expecting that the management to downgrade the guidance into 2H. So they should still be sticking to their previous share buyback commitments. And on this topic of capital returns, I think all eyes would be on OCBC following its failed GE privatization and the announcement of its CEO transition. So like having wasted 2 billion just for them to remain in the same position as before, we think greater clarity is needed for this capital returns anticipation. But overall, no surprises there.
Okay, all right. So all three banks, you have whole ratings on the sector. Which bank and what triggers might lead you to a rating upgrade?
I think this will probably be the within the three banks. I think where we are paying attention to would be DBS and UOB on higher potential for wealth management and fee income upsides. So there is where surprise upsides may be. We also expect that UOB could be reinstating their guidance following them pausing this guidance on 1Q. So with this better clarity for the second half, maybe they will reinstate their guidance. But overall, we should still remain pretty cautious of where all these upsides may go. So we still stay cautious on non-operating income upsides, and as I've mentioned, this may not offset the interest income weakness. So I don't think it will be likely, but if they outperform their wealth management and trading fee income, this would definitely be where we'll be paying attention to and upgrade on this end of the spectrum.
Okay, great. Thank you, Shenhao, for those timely and fantastic insights.
Okay. Thank you, Sengya.
Oops. Now, before we bring the program to a wrap, we also want to spend a few minutes talking about sustainable investing. Now, according to a study undertaken by the World Benchmarking Alliance in 2024, our research team has found that less than 10% of the world's 2,000 most influential companies actually met societal expectations towards human rights, working conditions, and corporate ethics. Now, we backtested to see if the Singapore companies under our coverage had superior performance if any of the companies met these compliance standards, including, but not to mention, governance and to some extent, environmental thresholds as well. The results were still a resounding yes in that sense. So we now cut over to a pre-recording of the research team's analytical process, conclusions, and recommendations.
Thank you, Seng Yao, for your introduction. So our myimpact portfolio was designed with the intention of celebrating social impact. While many ESG portfolios tend to be heavily concentrated on environmental factors, we saw that there was a gap in social factors, for example, workplace diversity, inclusion, and safety being overlooked. So we screened for the top 6 companies that performed well in such areas by placing more emphasis on social and governance factors. Our top 6 companies did not only outperform the STI subset in terms of ESG scores, but also delivered 9% stronger financial returns over the past year.
To give you more context on how this portfolio was built, we started off by placing more weight on the social and governance pillars. On top of that, we tailored these weightings across industries to reflect the relevance of each ESG factor. This ensured a more robust screening process, helping us identify our 6 impact makers. The myimpact companies are not just financially sound, but also leaders in social impact.
Now, based on the screening, we have selected 6 top impact makers, and they include Mint, UOB, SGX, Q&M Dental, ESR REIT, as well as Propnex. These all have very strong social scoring as well as governance factors, as well as long-term value creation as well. So these stocks will also see earnings as well as margin growth going into the long term. Now, we are aware that when you look at the ratings on these stocks, a lot of them have holes, but don't let this confuse you, because the time horizon we envisage for this model portfolio is for a longer term holding period, while our own recommendation structures are only for 12 months. We also measure the impact of this portfolio from emissions as well as water intensity as well, relative to investing in a similar sort of stock basket directly from the STI, and we also provide some governance and social scores as well. So we think that this model portfolio will enable you to have superior returns and at the same time make a social impact as well.
For The audience who might be interested in looking at the full list of companies that went into our model portfolio construction, you can download this report with the QR code that was presented earlier at the start of this program, or please reach out to your sales reps to get a copy of this report. Yeah. So with that, this is Seng Yao signing out. Have a fabulous trading week ahead, and we look forward to bringing you more market insights next week. Thank you very much for your time.